Turning now to Mike on the Money. Stocks in the U.S. are hovering near on the edge of a bull market. Haven't seen one of those for a while. Yeah. Mike on the Money joining us now. Mike Giordano with Williams Wealth Management. So, Mike, nobody's complaining, but what's driving stocks up right now?
There's a whole colossal amount of factors. The economy seems to be holding up better than what people were expecting. You know, that's one thing. Inflation, it's debatable how fast it's coming down, but it has been coming down, so that's another big factor. And then you've got some excitement here in the markets, and that's around AI, right? And this artificial intelligence has caught people's enthusiasm. People are like, this could drive a lot of profits in the future. And so there's been a lot of enthusiasm. And when you had a lot of people sitting in cash for the last year or so, people get a little bit like antsy, got to put money to work. And so that's kind of driven a little bit of animal spirits.
Yeah, that's interesting. That's an interesting dichotomy of things. So when the Federal Reserve meets, they're going to make a decision about whether or not to cut interest rates. They've been driving them up steadily for about the last 10 times they've met. They're looking at 2% inflation as their goal, but we're also like on the edge of a recession. What do you think they're going to do? Do they pause, or do they raise them a little bit, or what do they wait?
Well, they're definitely not going to be cutting.
Why does it affect our viewers? Like, people are going, oh, I'm so tired of that. Why does it affect our viewers?
Well, I mean, if you're in the home, if you're in the market looking for a home, or you got a HELOC, a home equity line of credit, or you're looking for a car loan, you've seen those rates float up. And I'm telling you, if you look at your credit card statement, that fine print, I even looked at mine the other day, it's up 5% higher. If I weren't to pay my bills every month, it'd be up 5% more than it was a year ago.
Huge. Yeah, that's substantial for people.
It's substantial, especially when you're looking at like homes where the rates have come up and you're talking about a major purchase.
Sure.
Definitely. Now, the Fed, they're not cutting, right? That's off the table, okay? So the question here is, it's been so easy for them to just say hike, 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 hike. Now we're in a place where they're like, is inflation coming down a little bit more? Should we skip this meeting and then we'll hike maybe in July if the data remains hot? But right now, the question is whether they either just hold for a little bit or they hike, and the policymakers are kind of split right now in that camp. But we are going to get a big inflation read next Tuesday. So right before they have to make this decision, they're going to get their latest look at inflation. So that could be the driver.
And so much will come off of that.
Absolutely.
And so then back to that R word, that recession word. A lot of people were saying it's going to happen no matter what the Fed does, blah, blah, blah. Are you looking for that inflation figure before you would say, or do you feel like we're going to head to some kind of a recession, mild or otherwise?
I mean, this is a little bit like if I drive 150 miles down the interstate, the likelihood of me getting in an accident is very high. Right. I don't know when it's going to happen, how it's going to happen, how bad the accident's going to be, but you're
putting yourself in danger.
You're putting yourself in danger. This is in reverse. When the Fed's hiking and they're putting the brakes on, they're hitting the brakes hard, 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 hard. At some point, it could cause the entire economy at one time to kind of slow down too much, and that would lead us into a recession. It hasn't happened yet, but that's the fear. The Fed doesn't want us to have a recession. They don't want to crash the economy, but they do want to cool it down enough to get prices in line. The big thing for viewers, though, is, you know, what we're talking about is something that could happen over the next month. It may or may not happen, but it's over the next few months, maybe a year. If you're trying to put money to work that you need in the next couple of years, you know, keep that in cash, short-term bonds, money market funds. If you got more than 5 years, then you can put that money into the market and just keep working it in, given your own risk tolerance. Because over a long period of time, look at history, we've gotten through every recession before, and so, you know, likely we do the same thing here.
Excellent. Have a plan.
Have a plan, yes.
Mike
Stay within your
Giordano,
risk bubble.
I always end up feeling more comfortable after hearing from you. So
I appreciate it.
Thank you so much.